we've just been doing these every week. We just hop on and just, chat about current events in crypto. And then sometimes we go in depth on certain topics that are just like related to it. And we've had some really awesome discussions, and people have asked some really great questions. So like at any time, like while you're on, if you have a question, feel free to just like chime in and ask it. And, we usually have a couple topics that we, set out to talk about, but then after that, like, we kind of let things go wherever they may. And we've, covered a lot of really cool stuff. So thanks for joining us here on Dipcatcher Radio. This is August 20th, Thursday, and it's been quite an exciting couple weeks around here. The two things we're going to talk about today are this like random cryptocurrency that we just kind of stumbled upon that has a couple elements of things that we talk about here a lot, like, coins that we really like, such as like Bitcoin and Hex. It has a couple interesting elements of those two. And so that one has been, pretty cool to buy and hold on to. And then following up from last week where we were talking about this obscure cryptocurrency platform called Yamv and this whole concept of yield farming. Where last week, like live during our call, we talked about how like we watched Yamv kind of like unfold as they found a bug in the code and a couple $100,000 got locked up, and there was just like all this craziness. And we literally just watched it live unfold in front of us. And today it's like perfect timing because the people that built this crypto Yamv, they are trying to, recover the funds and trying to issue a new version, and it requires you to like claim your Yamv version 2. And so it'll be some interesting discussion around like what are these cryptocurrencies? Like, are they companies? Are they just like social networks? Are they games? Like, what are they? And we're actually going to be claiming Yamv2 on, for ourselves, because, we bought some Yamv, to, kind of experiment with it. And we saw this like crazy thing happen. And so we're actually going to convert our Yamv into Yamv2. And that'll actually be a good example for people who are just learning how to use MetaMask to manage things on the Ethereum network. You'll just be able to, watch, how to do it, and we'll just talk through, because that's what we're doing when we're claiming our Yamv2. We're just going to be executing a smart contract, and then, and that'll be a really good example for people who are just getting started. So thanks for joining us tonight. So let me just pull up my screen, and then we're just going to get started. Telegram, who's on Telegram? If you're not in our Telegram group, we'll reach out and we'll send the link. We that's usually where, like, whenever things are happening in real time, that's usually where I post to first. So it's a great way to just kind of, keep in track what's going on. So the first thing we're going to just cover is kind of what's going on in Flow. So Flow is kind of like this obscure cryptocurrency that it launched a couple days ago. It launched, so 9 days ago, Flow came out, and it has like, it's like a very basic cryptocurrency. Like it basically does nothing except for just, exist. And what people are really drawn to about is something that we talked about last week, which is this concept of yield, and this concept of, just like, like by holding a cryptocurrency, you're able to like earn more of it. And so that's what kind of drew me to Flow. I literally just randomly read a tweet. I just browsed Twitter and see what people are talking about. And I found something where and the thing that people were like promoting about Flow was that it was just launching, and that the founder was locking up like half the funds to go into a liquidity pool. So they were providing liquidity for it. And people were just like, oh, and it pays 1%, they said that it pays like 365% APY. So they're talking about like this like big yield that you get, where the more you like, as you hold, your amount compounds, kind of like what Hex does when you stake your Hex, which is, for people who are new here, that's like one of our first examples of these like yield generating cryptocurrencies. Flow kind of has that element of Hex, but it has the fixed supply and the emission schedule of Bitcoin, where the inflation rate cuts in half abruptly every couple years. And so it has two, kind of like economic characteristics of some of the things that, we really like. And so it like that's why I was like initially drawn to it. And the way that it works, it's kind of like Ample, which we talked about last week, where Ample is designed to where when the price goes up, your balance increases, and when price goes down, the balance decreases. Like don't worry about trying to wrap your mind around that just yet, but like go watch that last week's video. But like Flow, by holding it every day, your balance just increases, and nobody sends you the money. Like it's not a transaction. It's just it just suddenly appears. It's like this like interesting property of cryptocurrencies, which can actually catch people off guard, is that your balance can actually change. And so it doesn't really matter what the number is in your wallet. What really matters is your percent ownership of the whole. And so Flow is kind of like an interesting example of this, where like every day there's 1% inflation applied equally to all holders. So it's almost like a universal basic income, where like everybody who holds the currency earns 1% of it per year. And that 1% is paid, just from inflation. So it's not collected like a tax and then paid. It's just like purely from inflation. But the inflation applies equally to everybody in the whole system. So it's as if nobody received it, because everyone is still equal. Like, the number went up, but like their relative balance stayed the same. And so it had like, in many ways, this sort of inflation in Flow, I think it's mainly psychological, like the impact that it's having. But people, just like the way that they measure their return on investment, they put $100 into here, and then when they think about how much that's worth, like they think about it in number times price. And so like in times like now, where like there's so much new interest because we're entering like the start of like this next major bull cycle, like on these 4-year periods that we discuss pretty frequently, that like there's already increasing demand. And so that increasing demand compounded with your balance just increasing, that's really attractive in like this current environment. And so that's why there's been a lot of demand around, like Hex, like that was like probably the first main, it's not mainstream because nothing in crypto is mainstream, but like and even Hex isn't mainstream in crypto. That's probably a bad example. Like Hex is probably the first large scale example of like kind of like this yield farming concept that's been coming out. And then that's really grown over this year. And that's kind of where things like Flow fit in, is where like it pays you more, but everyone else is getting paid the same. So the increase in your in the value of your coins, like it like price is already going up. And so like, the increasing balance, it doesn't necessarily, make that much of an impact. And so, I think it's primarily psychological. But the thing that could kind of give Flow this, just some like energy, is this halvening, like how in Bitcoin, the inflation rate cuts in half over time. Every 4 years in Bitcoin, the inflation rate cuts in half. I think in this one, it's shorter. So this one, every year, the inflation cuts in half. So those types of supply shocks, they cause a lot of uncertainty about the future. And so that's what leads to like crazy price runs. And so I actually like, because it has this like kind of built-in volatility, I think that Flow is one that is going to be a good one to be on the lookout for, like dips to catch. like you want to, you know, just because it has kind of like this like halvening, like when we look at the Bitcoin chart on TradingView, like that 4-year halvening causes those like bull and bust cycles. Flow kind of has that built in, but on a yearly basis. And so I think there's going to be a lot of volatility in flow. And what that means is a lot of opportunity for, you know, just like buying low, having opportunities to buy at like a, you know, a low price on a relative basis. So flow has been, you know, pretty just exciting. Like I just like love the simplicity of how it works. And the smart contract itself is pretty simple. Like, you know, that's
before you go on, can I ask you one question about the price? It's Colleen again. So where you're saying buy low, right? And this has only been a few days. So have we seen low? Like, I mean, we all bought a few like a while ago, so we kind of got in pretty early. But I mean, is this as low as it's going to ever get? Are we still in the low days? Are we just like nickel and diming?
That's a great question.
Almost like Bitcoin right now, just get in, don't worry about it, and go.
Yes, that's a great question. So, like when we look at the chart, so we'll share this link. This is a site that I put up just to help me look at the chart and be able to make a trade right here. And so this is when Flow launched. So about 9 days ago. And like the way that it launched, there was no like VCs involved, and like there was no fundraising involved. Like, you know how like in Hex there's like the whole like adoption amplifier concept, like, you know, that doesn't exist in this. And so like the price is like it's like one of the most fair like launches. And so like it's like it didn't have like the VC premium kind of baked in where like it's like a higher price but artificially. And so it like effectively, you know, has to start from zero. And so just because like, you know, getting in on that like first day, like, you know, it is nickel and diming because like, you know, it's gone up like 1,000% in the last week. Like from like, you know, from first time you could reasonably buy it, you know, to like right now, it's up like 1,000%. But that's because like buying down here, like if you bought, you know, at 0.1, every 0.1 price movement, you're doubling you're up 100%. And so like the earlier that you can buy, or just like the lower you can buy, the less that it needs to go up for your balance to double. You know, whereas like if you bought at, you know, 0.6, like, you know, you're still way up. Like you're up, if you bought it at 0.6, you're still up, what is that? 264%. Like you're still up a lot, but now it requires price to go up by 0.6 for you to go up 100%. So like, you know, it's certainly like, this is certainly very early. Like you can look at the, let's look at the, where can we find the, let's look at the, like, I think there's only like 1,300, only like 1,300 addresses. Okay, 1,500. So right now there's 1,500 addresses in Flow. And let's compare that to Hex, just because like, you know, Hex is like, it's still early, but like, you know, a lot of the major upside, you know, has already been allocated. So if we look for Hex, you know, there's 192,000 addresses. Like, and part of that is like, you know, not all those have Hex or like have much Hex, but still like Flow is very new. Like it's been around for 9 days. Whereas like, you know, Hex has been around for, what is it, like 250 days. And so like, you know, it's still like, it's starting from zero. And, you know, whether you get in at like, you know, 0.5 or 1, like it does make a difference, you know, like a pretty big difference that adds up over time. But like, you know, you can't go back in time. And so, you know, getting in the first like week or 2 week of these things, like it still has a chance of going to zero, but the upside from here, because there's so much risk of it going to zero, the upside can still be really big. So, you know, don't like, you know, don't lose money that you otherwise need. Like you don't want to like just go all in. Like some people in the chat room claim to like be all in on some of this stuff, and you can kind of check. Like when we look at the holders, you know, there's, you know, some people have like tens of thousands of flow. You know, so like, you know, people have significant amounts, but these people are also probably really wealthy. Like if we just look at like a random person who holds 79,000 flow. Let's look and see what else they have. Let's see. How can we view their app? We're just going to go to their wallet, and let's just count other people's money.
I love that, Brian.
Yeah, I've definitely come to love Etherscan.
That's a smart contract. So that's not a person. That's a little bit harder. That's a contract. So that's a little bit harder to look at. That's also a contract. You know, so like people that hold large amounts of these, they tend to, you know, they already have a lot of money. So, you know, you don't want to risk that because, you know, because there's so like, you know, it has every chance of going to zero. Like, you know, we can look at we can like look at the contract and like, you know, assume that it's going to be all right. Oh, that's hex. Like we can just like, you know, look at it and, you know, and it's pretty simple. Like literally like everything that runs flow fits in 759 lines of code. Like, I don't know what this code says. You know, but what I look for, and this is actually just like a good piece of advice, like in these coins, like the less Ethereum addresses there are in the contract code, the better. So like numbers, like, okay, that's not an address, but numbers that start with OX. So like if we just search in this contract, like you just kind of tap through, like those are just numbers, regular numbers. Okay, that's a potential Ethereum address, or that's the contract address. I don't know, let's just keep looking. Okay, so in there, we only found one thing that looked like an Ethereum address, and that's like a good sign because it means that they don't have addresses that can like take all the money. And so like, that's like a good sign. And so like, I don't really know what all this code says. You like, and that's part of the risk. Like, you know, I don't have enough time or like money to like properly audit this. And so like, that's why, you know, part of why it can go to zero. That's like why Yamv like literally like went to zero. But you know, there's still a lot of risk involved in flow because it's so new. It hasn't been tested. You know, nothing bad has happened yet. We don't know what bad thing could happen. So like the more risk there is, the more reward there is. And so, you know, I think it's definitely still early, but you also, you want to be buying at when the price is dipping. You know, you want to be buying, you know, when, you know, people are selling. Like you don't like, yeah, it's fine. Like if you must, like, you know, you can buy when the price is going up, and usually, you know, that like people still have success doing that, but you want to have enough money so that you can buy at a low price, because buying at a low price just like really like, you know, if it's something that you might want to sell sometime in the near future, it's better to get a low price, you know, because like, you know, this doesn't quite fit into like our like long-term like 10-15 year holding strategy. Like this is probably a, you know, something that you buy and then you trade the like for the like 1 year market cycle, kind of how we do in Bitcoin, like where, you know, the 4-year halving cycle creates these like bull and bust cycles. I think flow fits into that. So it's still too early to like put like serious money into it. But it's definitely one that like, you know, could turn an ETH into a couple of ETH, and that's like, awesome performance. So,
Brian, did you get in on the first day?
huh?
Were you in on the first day?
Yeah, I received the first ever, what was it called? Rebase.
Mm.
And so what that means is that the balance, it goes up 1% per day.
Mm-hmm.
So if you had if you bought 1,000 flow, and the interest rate is 1%, or the inflation rate is 1% per day, and so like if you at the end of the first 60 days, it's going to be like 1.816 times 1.816. So it has this compounding effect where like it's 1% per day for 60 days, but you're not just earning 60%, it's compounding every day. And so the balance is going to go up, but everyone's balance is going up at the same time. And so it, kind of evens it out, but people like just love that psychological impact of price going up while balance going up, because it just feels like they're up extra because they're measuring in dollars, right? And so like what that really means is that price is really going up. Like this is price is going up at this aggressive rate during a time of very high inflation. Like today's inflation rate in flow is 365%, like per year. Like that's massive. I mean, that's like not even, that's like US government style inflation. But because the demand is so high in this one, partially because it's starting from zero, and partially because like the developer apparently locked up the liquidity pool. Like we can look at you can look at pools at FYI to look at flow. And so,
what does it mean, Brian, that he locked up the liquidity pool, or they?
So he deposited, let's see how much okay, so 98%, so 0.9858 times 1144. So he has 1,000 Ethereum. He has 1,127 Ethereum, and 359,000 flow that is in a contract to be a liquidity provider. So remember when we talked about like yield farming, where like you're providing liquidity by you hold an equal balance of Ethereum to flow, and then you can come in and you can just deposit that in this liquidity pool. And when people are buying and selling from you on Uniswap, like a buyer is not buying from a seller, the buyer is buying from the liquidity pool. And at the same time, a seller is selling to the liquidity pool. So the liquidity pool always keeps an equal balance of Ethereum to flow. And so the developer deposited, let's see if I look in the Telegram, let's see if we can look at, okay, liquidity lock. Here we go. So I don't really, so the developer just like, I was trying to find how much the developer put in liquidity. I don't know, but he put a lot of his own money up to be the liquidity pool. And so that just like makes it a good place to trade and like, invest in. And I'm not sure if like the pool is actually locked up, because joining a liquidity pool is the same thing as just doing a smart contract. Like like what we're doing with, and I can even show, as an example in a little bit, I'll even show you how to exit. I'm in a liquidity pool right now for Ample. I can even show how to, like, what that really means if you all care. But the like the developer put a lot of his own money up, and so that, like, that's part of what's like causing a lot of the demand, because like a big risk in these things is just like the person who created it is just going to dump their coins on the market and drive the price to zero. And so like in Flow, here we go. This is how, like, they publish how they claim they're going to issue the coins, and the creator only gets 5%. And I think it comes after like the first year or something. And so like, it still is a risk that, like, this like 30% could end up, I guess that's liquidity mining, that's different. So like this 15% could dump on the market, but that's not necessarily a very high amount. So people actually have, like, faith in this, because the creators don't really have, much. They don't have like that much of the coins to dump. And so there's just like a lot of, people are excited about it. The Telegram chat is pretty crazy. And so, it's just, there's a lot of hype going on, and that's kind of what you're playing in these things. Like, this is like, I don't understand enough about this to, like, really endorse it. How, like, in a way we kind of, we like endorse things like Bitcoin and like Hex, because, like, those are like less risky, like, and it's a little safer for me to, actually, like, actually I recommend, to my friends, like, of course, like, not financial advice, like, don't go to a financial advisor. Like, they won't know what this stuff is. Like, ask me. Like, I'll definitely always do my best to, like, try to help people. But, but like, I try to never stray people, like, to things that are really going to wreck them. And so, this one hasn't kind of met my bar yet, but it's still one that I'm really interested in, and it's super fun, and hopefully the price goes up. So, I think this is one that, you should keep your eye on, because it's like a good, simple way to start getting acclimated to the stuff, and start learning for, different characteristics that can help prices of coins go up. So we can share the contract address, or if you just go to flowpro.anvil.app, this is where you can look at the chart and buy. So what you want to be looking for is times when, let's pull up the Bollinger Band. So when price is in this lower half, that's a good time to buy. So like all down here, let's pull out of it. So like, that's a good time to buy. And price is below this line. And so, that's probably like the best way to approach this, because like there's definitely a lot of hysteria, and like, it's still very early in all this stuff. Like it's definitely mature. Like for people that are like very active and like very in, like, that are part of this stuff, like these concepts have been going on for like, about a year now. But now it's like really starting to become accessible, and people are like, finally figuring out how to use MetaMask, finally figuring out how to, look at these things and learn about these things. So there's still a lot of, I think a lot of upside to some of these. So, you don't want to be buying the top unless you're prepared to hold it for longer. So be on the lookout for dips. And if you join the Dip Catcher Telegram, like that's, if I identify good buy and sell opportunities, like that's, that's where I post them. So, join our Telegram, and, this one will be one of these ones that we keep monitoring, kind of how we monitor Bitcoin and Hex.
Hey, Brian, quick question. When you take profit, are you just putting it into your Bitcoin, like stacking sats? Like, what's your game plan? Like, how does that like full cycle sort of happen?
So, as of now, just because like Ethereum is the one that you can use to like buy things like this, I just keep it in Ethereum. And because Ethereum's like, Ethereum's a strong performer as well in this environment. And like Ethereum's like, I mean, Ethereum just has like massive upside potential but there's definitely more like it goes in cycles. And so like there are times where it's good to be holding Ethereum, and there's times when it's not. And times when it's good to hold Ethereum is when like people are using it to invest in other things. So like because in order to buy Flow, you have to buy Ethereum first. In order to buy Hex, you have to buy Ethereum first. In order to buy Yam and Yield Farm, you have to have Ethereum first. So like new money coming in first goes through Ethereum, and then it goes to people who put that Ethereum to work. Like the people who are building these things, or like people who are like, who are in the DeFi space, like DeFi runs on Ethereum. So they're holding Ethereum. So the time when like a new dollar coming in is then like sold as profit to somebody who's like, the type of people who are in this market right now. The Ethereums aren't really coming out for dollars. And they're even not even leaving Ethereum, because if they, usually like on Binance, like in the last market cycle, when all the trading was done on Binance, which is where you have to have an account and like, they're custodying your coins, and you can instantly trade between Bitcoin and Ethereum. Like profits on Ethereum to like altcoin trades would go into Bitcoin, but a lot of the profits are actually staying in Ethereum, which is pretty interesting. It's different than the last one, but it makes a lot of sense because in Ethereum, there's something called wrapped Bitcoin. So let me just pull up the, oh, Hex is pumping today. That's nice. So there's wrapped Bitcoin. And so this is like Bitcoin that is locked up in a smart contract, but not really locked up in a smart contract, because Bitcoin doesn't operate with smart contracts. It's actually held by Nexo effectively, or the company that like we've shared in some of our old videos is a lending service called Nexo, where you post Bitcoin as collateral, take out a loan. Like you're holding your Bitcoin with a custodian called BitGo, and BitGo is the one who does who custodies the Bitcoin for wrapped Bitcoin. So like, people are buying this, like taking profit in it, but it's not that useful, and there's a lot of risk involved. And because the price of Ethereum, like Ethereum has been out competing Bitcoin for all of 2020. So like Ethereum has just in general been a good hold anyways. And so, but it's more of like an active trade, because like measured against like Bitcoin, it's like there are times when price is really high, and then like, there are times when price is really low. And it all depends on like what the market cycles that are happening on top of Ethereum. Like in 2017, this was the ICOs. So these like crazy, wacky startups were saying, we're going to put, we're going to put like, basket weaving on the blockchain type of stuff. Like, and there was all this craziness. People were buying Ethereum to invest in these like wacky startups. And then the founders would just dump the coins. So like all the money that was raised to go to the ICOs in 2017, it got sold off, over the course of the next like 2.5 years, and now that, all the ICO founders have like cashed out all their ETH, and at the same time, all that hysteria funded a lot of development in these decentralized exchanges like Uniswap, and just the Ethereum ecosystem in general. Things like Hex came out on top of Ethereum, and like, now that there's a lot of activity in this DeFi space, it's pushing the price of Ethereum up. And so I like even over the next couple of years, just, holding Ethereum is still a good bet. Like, there are going to be things that outperform Ethereum. Like over 2020, like Hex, even amidst this like crazy sell-off, even though like, you know, we have like our first major bear market in Hex, we're still up 1,000% over Ethereum in this time period. So like things certainly outperform Ethereum, you know, flow, like if we look at flow measured in, this doesn't show it doesn't show it properly. But like, you know, so things outperform Ethereum, but even like if you miss like, you know, like kind of what we were talking about a little bit earlier, where like, you know, if you sold, you know, flow at $2 and then you didn't buy the dip and then price continued to go up, like, you know, you could have had more, but it's okay. Like I'm still happy to have that ETH. So it's like, that's kind of a good thing about things like this and like Hex too, where like, even if I bought Hex and then price went down further, I'm still happy to have the Hex. So it's like not that big of a deal. And if like, you know, if you sell and then price continues to go up, you know, as long as the thing you sold for is something you're still happy to have, that is still going up, you know, you don't have to feel so bad about timing the top and bottom so perfectly, because it's very difficult. And so that's kind of like the underlying, you know, dynamic here, is that like taking profit at whatever price is good, because like, you know, you're increasing your balance, and you know, and just for like, you know, convenience, because the trading happens all on ETH, the flow profit doesn't really go back into Bitcoin. Like the way I compound Bitcoin is separate from the, like, this is like what I consider like high risk. This is like high risk e-commerce, like, you know, where like you're trying to buy the thing that's going to sell well in the next couple months, whereas, you know, Bitcoin is kind of like, that's like a real estate play, like where you're trying to accumulate something that, you know, you can leverage later. And so it's just like a different strategy. So that's kind of why, you know, why it doesn't, you know, this activity that doesn't necessarily flow into Bitcoin. Yeah. So, yeah, check out Flow Pro. You know, what I love about Flow is it's so simple. Like, you know, Hex, it like takes a while to really unpack, because there's like different dynamics. But, you know, Flow, it's really simple, and it's a good way just to kind of, you know, like kind of like Hex was like a good way to start learning how to, you know, how to set up your MetaMask wallet, how to make a trade on Uniswap, you know, how to do these things. Like, you know, this is, you know, you just got to practice, and things like Flow are good things to practice on, because, you know, if you just put a little bit of money in, just like, you know, to kind of, you know, get your bearings, you know, it could go up, and it could, you know, get pretty excited. Then you want to learn more, and then, you know, you're more confident, you know how to troubleshoot. And so overall, like, you know, if you're going to start practicing, you know, on how to do this stuff, like learn how to get some ETH, and then, you know, learn how to use Uniswap is a great way to do it. And so flowpro.amble.app, we'll definitely share this link. And, you know, we'll keep having fun there. So yeah, so that was like the first main thing that we were going to talk about today, was flow. We'll share these links. The next thing that we want to follow up on is Yamv. So last week we watched this like craziness unfold, where there was a critical bug in this like thing called Yamv. Yamv was this, what we were talking about last week, was this whole concept of yield farming. So people have been making these like kind of meme coins, you know, named after vegetables, because like you know, you're farming it, and like there's kind of like this like subculture around that, and it's kind of a race to zero, because like you're effectively like either borrowing or lending money, and then using the borrowed money to like lend money. So it's like you're just like arbitraging like interest rate effectively, and just different like, you know, like coin distribution things, like with Flow, like the increasing inflation paid to everybody makes Flow like something that could be used in like a farming application. So like that's a whole different topic, but like Yamv was like, you know, this like platform that enabled that. And what they had a critical bug in their code that locked up a bunch of money. And when we go to, let's look at the charts, we remember what happened. So Yamv is meant to be pegged to $1. And when price is above $1, your balance goes up. and when price is below $1, balance goes down. And so the like it's part of this like hysteria. We're like, and that's why people like flow, because it's kind of like it's like this, but like your balance only goes up. Like when price is below $1, like your balance is going down. And so like we look at like my Yam balance in this time, my Yam balance has gone from 6 to 150 to like 66 to 74. And so like it's one of these rebase coins, which you should watch if you're interested in hearing about that. Watch last week's video and some of the snippets. But so last week Yam failed. They had a critical bug, and today they posted this Medium article about how to like they're gonna set up Yam version 2, and it's gonna be a placeholder that doesn't do the rebase. Because like people want to hold on to it, like they want to do this Yam thing, but like they don't want to like be rebased to death. Because like the thing that part of it broke, like it can still kind of work, but not how it was intended. So people want to get out of this. And so the people behind Yam, are issuing this like Yamv2, and it until Yamv3 is fully audited and they can like hire people that are going to review the code and like test it. They're just going to have this placeholder until that one's ready to go. And so they just announced this last night. And so like, it's pretty funny to see this play out, because this isn't a company. Like Yam is not a corporation. It's like not even an organization. It's literally like a handful of just like individuals that just like built this. And like it, and it's kind of like a loose knit type, thing. And like they keep a certain amount of the supply for themselves, and that's just like built into the code. And so, but it like people, agree to adopt it and like factor in, how much the initial team get, so it's like in effect, like you're paying them in like, either like the initial supply that they get, or in like whatever amount of the inflation that they get. It's like you're paying them in that. And then, like the return on your like investment, is like the thing to like measure that against. And so it's like, in a way, it's kind of like, you pay a company so that they can continue to provide you a service, or like you pay them in exchange for having provided the service. And so like that was like, with this, it's like nobody had to fix this, but like the people that issued it, like they had enough at stake where they wanted to, because like it was the creators of this whose money got locked up. And so they want to like salvage that. They're not going to be able to unlock that money. I think it's money gone forever, but they'll be able to like, do the thing that they were hoping to make money on. Like, they put up, I think it was like $600,000 that got locked. They put that money up, or they put a large portion of it up. And so like they did that because they were going to try to make a return on that investment. And so like, that's, that's like just part of the dynamics of these things, is like you factor in like how much the founders own and what stake the founders have in it, or just like the people involved in it, or just the people that might have joined after the fact. Like, are there people that maybe weren't part of creating it, but they bought in early? And so like, every 10% up that the price goes, like their balance is going up like 100%. Like, there's, people that just have a vested interest, like they're the ones that like act to execute on this, and so it's like, it's not like a formal company at all, but it's just like a mutually agreed upon like set of terms that are laid out in the code. And like, even Yam was like, telling people like at the start, like they have these old tweets. They like tweeted that like, this is not audited, like use at your own risk. Like, this is experimental. Like, people still put a ton of money in the system. And but like it went down in value so much because it had like a critical bug. And so like that's like part of the risk. And when we talk about things like going to zero, that's like kind of what it means. Like, you know,
Brian, is there anything like this in the other world, the non-crypto world? Like, does anything like this exist?
kind of, in a way. So margin trading. So when we talk about like borrowing money, like when price is low, borrow dollars, buy Bitcoin with it, and then, you know, a little bit later sell the Bitcoin and then pay back the dollar loan and keep the difference. Like, you know, we talk about that here in the context of like averaging into the lowest price of the month, you know, and we do like 1 to 5 leverage at most with like a tiny portion of what we have. Like, you know, that's leverage trading, that's margin trading, but that's like a responsible use of it. High margin trading is kind of like this. We're like binary options. Where like during a certain window, price is going up and your balance is going up. So if you bought and sold during that time, like you're in profit. So there's like a tiny window of like profit. And like same at the bottom, like if you bought when price was low and then sold when price was higher, but when this is low, like your balance is decreasing. So like there's like a tiny window of opportunity here of when you should like buy and sell. So it's like a binary option. So it's like a high risk, like high margin trade. So that's kind of like what it is. But in terms of like balance going up as price goes up, and then balance decreasing as price going down. I mean, I guess there are other things like, but it goes kind of more in one direction where like if the price of copper goes up, it makes more sense to produce more copper. So the supply of copper goes up. But as the copper price goes down, like maybe like, you know, there's a little bit less supply because like copper is now cheap enough to buy for like, you know, different applications that like remove copper from like copper that could be sold, I guess. So in some ways it's kind of like copper, or things where like when the price is high, there's so much available to produce that like, you know, they're able to produce it. And then when price is low, stuff that has already been produced is now cheap enough to use for other applications that'll like remove it from the supply that could be sold. Maybe it's kind of like that. I don't know. I'd have to think more if that's a really good example, but you know, there is this dynamic at play, but in here, like the orders of magnitude change is just massive. And the time that it takes to make that change is so small that, you know, it's just like you know, it's different here, but it's things like this do kind of exist elsewhere. And so, yeah, I mean, you know, yeah, you'll have to watch last week to get full context, but today we're actually going to migrate our YAM. We bought some YAM in time for last week's thing. And this one is down like this, you know, this is like, you know, this is why you shouldn't risk like, you know, big money on these things, is that like, it can go down a lot. And, you know, and like, you know, so you don't want to like, you know, on a whim, just like buy some random thing, especially buying it when it's super high and, or like the price is going up, because like, you know, something like that could happen, you know, on something that like, you know, cause you don't know, like, how can you predict that? I mean, I guess a lot of people predicted there would be a critical bug. So I guess this one wouldn't be that hard to predict, but you know, with, you know, other things like it's hard to predict what's going to happen. And there's always, especially with new things, like literally that was found on its first day. Like that just shows the risk of getting into things super early before they've had time to be tested. Like here, it was tested with its first balance adjustment, and the first balance adjustment showed that it had a critical failure. And so like, that's like the risk of like getting it on day one. And so like, you know, when it works, and like the reward pays off, like what we saw in Flow. But getting in on Flow has worked out great. Getting in first day on YAM, not so great. So like different, you know, you never know. And that's why it's so risky. Like that's why for most people getting started, like just buying like Bitcoin and Ethereum and Hex, like you'll probably be fine. You know, Hex is probably the, you know, in some way it's more risky on the short term basis, but I think it's going to be less risky on a long term basis. But like for most people, like getting started, you should, you know, hold on to those. But then like with money that you might otherwise spend on like, you know, a movie theater, or like, you know, money you're spending on Netflix, or money you're spending on eating out, like whatever, you know, stop doing those things for a month, put that money into like some like random thing that you hear about on a whim on Twitter, and it might work out. And so, you know, definitely you don't want to like risk you don't want to risk the farm on a yam farm, because you just might lose your real farm. But if you know, you can risk your Netflix, you know, what you're going to pay for Netflix over the next couple months. You could risk that on yam for sure. And if it doesn't work out, you know, fuck it. But today we're actually going to migrate. So this will actually be a really good example for how to do a smart contract. Because that's what Ethereum is. Ethereum's like main use case is like using other financial products. You know, so like when you're buying Hex, you're using a smart contract. When you're staking Hex, you're using a smart contract. And you know, when you're, you know, migrating Yamv1 to Yamv2 because they're trying to prepare for Yamv3 to fix a critical bug that emerged 12 hours into the launch of Yamv1, you do a smart contract. Like, you know, whatever it is, like that's just like that's like the training wheels thing. Like you got to learn how to like ride the bike. So this will be a perfect example, and then we can, you know, kind of speculate on what we think is going to happen with Yamv2. So view migration checklist. So I need to approve the contract. Confirm. Okay, so we actually had to approve it. So approving the contract is putting forth an Ethereum. So what we did here is we executed a smart contract that says that we approve Yam to be spent from this website. So you can speed it up. I didn't speed it up because like it's already pretty expensive. So like to do that, to just like set up, like to get ready to migrate the tokens, I had to spend $3. So my Yam balance is like $70 or whatever it is. I don't know how much it's worth right now. Okay, so a little more than that. So this is about $100. I had to spend 3% just to like start unlocking it. And it could take, let's see how long it thinks it's going to take. So it thinks that this is going to take 43 minutes. Oh my gosh. Oh my God. Like literally, like gas is really high. Like gas is the transaction fee. Okay, this isn't that high. Let's see. Maybe we'll speed it up. Okay, we'll speed it up. That's not a bad use. Okay, it's not that high. I mean, it's high for sure. But so what the issue here is that when I tried to execute this contract, I only put forth the slowest amount of gas. So I only paid $3.20. But if I wanted to go through faster, I could speed it up. I could increase my transaction fee. And that's how this works. There's a finite amount of these transactions that can go through. And even though this isn't a transaction, this is me just like approving my Ethereum address to interact with this smart contract. Like it's just like a security thing. Like, you know, I'm unlocking my wallet. You have to pay to get that information saved to the Ethereum blockchain. So you have to pay for some storage space is what this is. Storage and transmission. Sometimes, you know, there's a finite amount of these things that can be saved at, you know, per unit time. So sometimes when a lot of people are doing stuff and a lot of people are trying to get through contracts and these contracts have a lot of operations, they can be expensive. You know, the prices go up, but you know, right now this is actually pretty low. So we're just going to speed it up. 353. Okay, it failed. Let's see what happened. This is good. This is live troubleshooting. Literally, this is like, if this ever happens, it's like, it's always safe. Like it's very hard to go. The only way you can go wrong is sending something to the wrong address. But what we can do is we can just look at this and see why it failed. So it failed the post. So let's see. live troubleshooting here on. And so like, I'm doing this and, because I want, like, I know I heard Colleen say something that she helped, someone who's kind of frantic. They thought it was lost, but you can actually always count on it. It's actually not lost. Like, unless something really broke. But, so here, what we're going to do is we're just going to retry the transaction. It didn't let me speed it up. Oh, it was already approved. That's why it didn't work. Okay, so, okay, nothing was broken. I just tried to speed it up, but while I was trying to explain what speeding it up meant, it went through. So that estimate was, yeah, okay, we are good to go. Crisis averted. Okay, so I did that, unlocked it, I harvested it. I was actually using the Yam harvester, but I had already unlocked that. Got it. So now I'm going to migrate to V2. Burning your Yamv1 for Yamv2 is a permanent action. So I have a business decision to make. Like, so right now Yamv1 is getting burned, but Yamv1 is still trading. So if I burn it, I can't sell the Yamv1, but as people are burning it, the Yamv1 supply goes down. And what if there's failure with Yamv2? Like, what if that breaks? So like, there's a chance that Yamv1 could pump again, and it could pump higher than what Yamv2 might pump in that same period. And so, like, this is part of, like, the unknown future, and that's what gives energy for price to move, right? Like, so, I think that I'm going to try to see what Yamv2 is. In this case, I'm going to go with the herd. Sticking in Yamv1 is probably like I don't think like all the people that have a lot of Yam are probably moving to Yamv2. So I think they're burning like the large pools of Yam that could have something to gain. They're probably moving. So I'm going to stick with that. So we're just going to migrate, but we'll keep an eye on what happens. We'll see if migrating was the move, or waiting for a Yamv1 pump to happen and then exiting. So we'll keep an eye on that moving in the future. But just to migrate, you just click that. So here it's $14 because the previous one was just approving this contract to interact with my wallet. Now we have to actually execute the contract. So this one has like a couple of operations. You have to like burn the coins, do all this. And so let's see what the gas fees are. So already fast. So we'll just leave it at that. We'll try to just move it through. What's the difference between? I mean, I guess the difference could add up, right? If it goes up 1,000x, like that $1 difference, could make a difference. But just for the sake of it, we'll just set it to fast. It's good to support the mining ecosystem. It's good to pay. It's good to overpay if you can, because that keeps the incentive to for like the system to be secure, and it also creates a price floor. But yeah, so that's what the gas fee is now. So that's pretty high, like compared to what I'm pulling out. So far we've paid $3.20 plus $14, so 17. We've paid so 17 divided by what do we get? Like 75 times 1.4. So we've paid 16% fees already, like just to do the contract. So like that's part of why like these things like this are harder to like get involved with in small quantities, because that's just like a massive percent. Whereas like somebody who has a couple $100,000, like they're paying the same gas fee as you. So to them, it's just like a much smaller percentage. So keep an eye on the gas fees. There's like, it goes in cycles, like when a lot of people are doing stuff. So times when like a good frame of reference would be to look at like in a very liquid, and then let's look at the volume on here. This is a good proxy for gas fees, is trading volume, because trading takes up a lot of gas. So when trading volume is low, it's cheaper to do stuff like pennies. When trading volume is high, it's more expensive. So, that's just like a reality of it. So that's why smart contracts are a little bit harder to operate with on smaller amounts of money. But that's just the market. There's supply of Ethereum block space, and then there's demand for it. And so the price is set at the margin. And so let's see the status of this transaction. So we migrated, and now we have 7.2 Yamv2. So that's pretty interesting. So, we just look in here. We need to add a token. So we just got the Yamv2. We're going to add a token. First, we need to find the Yamv2 token. Let's see if we can find it in here. Okay. Yamv2. Let's see if this is legit. I don't know. If we see our address in here, we'll know. Or what did we do? It was like 7 Yam a couple seconds ago. I don't know. Let's see. That'll be hard because there's all these trades in here. So I think that's it. So we can copy this, and then we can go to the Yams, or we can go to our wallet. We're going to add a token here, and then we are going to custom token contract address there. Okay, Yamv2. We just add it. So now there's our 7.2 Yam that shows on our screen, and our 7.2 Yam that's there. So whenever you get like a new coin that's not like by default on there, you may have to add it like that. So you go to Ethereum, go to Etherscan, copy the contract address, take it into your MetaMask wallet, and then, I didn't even save it. So here, we'll just do it again. Take it in there. Next, add tokens, and then you just add it. So now, there we have it. So we just secured Yamv2. Let's see if we can find a Yamv2 price chart anywhere. So let's go to the Telegram chat in Yam, and we shall search Yamv2 chart. It's maybe someone, I think I asked it. Let's see what the price is, because I don't think Yamv2 is on the other sites. Okay, that's all right. I mean, it's been going back up, so you never know though. Like, who knows what's going to happen? So that just rolled out today. So yeah, now we just successfully migrated our Yamv1 to Yamv2, and we'll see what the second chapter of Yam.finance has in store for us. This is pretty, uncharted territories.
I know, it's really fascinating to be watching you do this. It's very cool, Brian.
Yeah, it's truly the Wild West. Like literally, like Yam farms included. Like it's so this still remains to be seen what happens there. But I'm excited. I think that kind of how we talked about last week, like it's probably gonna kind of be how Ample. Oh my gosh, remember we drew this chart last week? Look at that. Literally like kind of how it's going to spend some time above where people are, buying more because the balance is going up. When it's above the price target, your gains compound. So people are buying, but then when it's below, your gains are decompounding. And so, I like these like cycles are going to take place. I think this is what the Yam chart, it's going to have elements of this. So that's probably what we have in store for Yam. And so maybe we can infer what's going to happen to Yam by just looking at the Yam, the old Yam chart. So Yam started way above. like way above the target price. And so this is what Yamv3 will be. So Yamv2 doesn't have this like rebase price dynamic. Like the balance of Yamv2, it does, like it says, no rebases to serve as a placeholder. So what they're gonna do is like Yamv2 is meant to pause this rebase, because I think that if like on regular Yam, if the rebase continues, it's just gonna like drain a bunch of money. Like I think a big amount of, like a large pool of funds was permanently locked, but the longer that this rebase goes on, like every day it gets worse. I think it's just gonna like drain a bunch of money. And so like burning the Yam helps to counteract this like this thing from happening and like transfer the value somewhere else. So Yamv2 is just like a placeholder now for Yamv3. But when people are speculating on the price of Yamv3, the data that they have to make decisions and make calculations on, all they have is Yamv1 chart, which was like literally like Yamv1 had, I think it was actually 24 hours of like of it working before they realized there was a serious bug. And so the price of Yamv1 was, excuse me, it's smoky of these wildfires. The price of Yamv1 was like up at like $100. And so everyone's balanced like 10x because the target price is $1. So everybody got 10 times as many Yam, and so the price dumped. So like the price chart's hard to like look at. You should really look at market cap because it factors in that like the balance increase. But like when the bug was found, the price got as low as 0.1. So like there was like massive losses. And when price was that low, people's balances get cut. When price is above the target, your balance multiplies. When price is below the target on these rebase coins, price diminishes, your balance diminishes, it gets divided. People had big losses here. So even though price has been going up, people's balances have been going down every day. So like, buying here, you're not really up 10x. You're up 10x divided by whatever amount the negative rebase was happening because the price is below the target. So, there's that dynamic at play, but this is all that Yamv3 has to look at. So maybe this is like the new bound. Like maybe if the price target is, price target in Yam is $1, and we're looking at the log chart, and if price got as high as this, like, let's see. So if like we think that like overall, like if we think that Yam is going to grow in the number of people that hold it, like say we take Yamv3, like starting from now, like if we think it's going to grow at like some like, so 30 degrees would be, every three, like, going up, like every day going up, like three parts up for 4 parts over type growth of just like overall demand in Yam. And then we use that, so like, this like move from like, 1 to 0.1 is like proportional to like, the move from 1 to 100, which I don't know if we'll even really get this high. That was preposterous. That was pretty frothy. So say like the real, let's try to find like a real like price ceiling for Yam. Let's take this one. This will actually make it easier. That like 10x rebase, that was probably a one-time thing. Probably the more realistic scenario is like this, like, 5-to-1 rebase. So let's take that one into effect when we're trying to like predict what's going to happen. I think that was unnecessary, and like that was anomalous. That wasn't like, I don't think that was like a regular thing.
Is everybody unmuted? Is everybody unmuted?
I think
No, I think, yeah, we're unmuted, or we are muted.
I wanted to ask a question, and it's
sure.
probably going to be so basic, but what is a serious bug? What does that even mean?
Yeah, I mean, like, so their code wasn't good. They, you know,
Oh,
like it's so like I'm a like my day job is I'm a software engineer.
uh,
I don't even understand the scope of what it was, but something that caused it caused a certain wallet in the ecosystem to get too much of the supply. Like you'll have to watch the last video. It's like this is like a very like a very new concept of these things. It's like this whole rebase coin concept. So like there's a lot of context involved in this, but somehow like one particular wallet, it should have gone up by like, you know, 20%, but it went up by like something absurd, like millions of percent. So and because of that, because this thing like relies on like some measurement in how like this thing calculates what to do, it like that massive number just like threw off this calculation, and so permanently like made it so that like a certain thing that's supposed to happen could never happen because the number just won't have launched. You can't change it. Like it's very hard. Like it's hard to correct certain things, and so their code like that they're trying to use to operate this system that like, you know, it tries to self-regulate the price to be in like equal to $1. It's trying to be they're called a stable coin. So it's trying to hit this price target. And that's just like the way that this like mathematically, you know, tries to achieve that, you know, that price. Like that's just like the economics of it. The software that runs that just had a bug. And the bugs are especially hard to fix because when you publish the contract to Ethereum, you set it in stone. Like, you know, it can't, like when we go in here on Etherscan and when we read this code. So when we look at, this is Yamv2, but if we were looking at Yamv1, something in their code was wrong and it caused their system to like permanently freeze. And so like, in order to recover from that, like, you know, they want whatever system they were trying to build, they want that to exist. And so they saw where they went wrong. And the only way to fix it is to issue this like temporary coin that they're going to try to like fix that bug they had in the first try on this new one and try to like restart. And so a lot of people lost money. They didn't lose it all. You know, they lost like maybe like 80%, but like, you know, they're trying to fix it. So like, that's kind of what like a bug in this, you know, means. It's like literally like a bug in how like the software that runs this system, because it's like not run by people, it's all run by software. The software has to be right the first time. You know, like I work at a legal tech startup, and there's certain things where like, you know, bugs can have a big impact, but a lot of things where, you know, even in a legal tech setting, you know, bugs, like as long as it's reliable, like 98% of the time, or even like 95%, you know, just certain things, like certain bugs have like various degrees of impact. You know, in that world, you know, bugs are like pretty important, but even still, like there's tolerance for it. But on things like, you know, like a GIF, like a meme website, if it's down for a couple hours, like, you know, that's probably fine. Like there are bugs there, it's not a big deal, it can be fixed. So like, you know, in that setting, like bugs aren't as important, but in like financial applications, the bugs are really important. That's part of the risk of getting involved in things that haven't had time to be tested with time.
Yeah.
You know? So that's like an important concept, you know, across really all the stuff. Is that like when we talk about like when we talk about how high Hex can go or how high Bitcoin can go, a way we estimate that is what's the odds of it going to zero. And surprisingly, when the odds of it going to zero are really high, the potential outcome is also really high, because with so much risk, there's a comparable amount of reward. And so like, you know, but like, so in this case, like, you know, the risk was really high that it went to zero. So there was like, you know, potential high outcome, but it actually went to zero. Like it had a critical failure. Well, it didn't go to zero, it went down like 80%. So like, that's like, you know, it's a pretty big loss, but like, you know, this is a prime example of like, you know, this is like the level of risk that's involved. And when it works out, it's great, but when it doesn't, you know, you don't want to lose your real yam farm gambling this stuff. You know, it is speculation and it's very early stage. So, you know, bugs matter.
Yeah.
But people are very forgiving too. Like people are still trading it, even though there's a critical bug in how this works. Like people are still buying and selling it and making money. So like, you know, people actually do have a high tolerance for bugs sometimes in financial applications. Yeah.
Interesting.
Yeah. So, you know, we'll probably see the price of Yamv2 oscillate, you know, oscillate around the, we look at here, like if that was like the high was there and the low was like right there, you know, maybe like, so this is being interfered with because, you know, the Yamv2 thing, like, so like there's not like the true market cycle taking place because this isn't Yamv2. Like Yamv2 doesn't exist yet. Let's see if we can find the Yamv2 one. You say oh yeah, here it is. If there's candle, I like candles a little bit easier. If we look at the 24-hour, so it's only been around for like 24 hours. So like, it's not even enough data to really like work with. And it's above the target, but this one doesn't rebase. So this one won't have, like Yamv2 will not have that like oscillation built in because Yamv1 is still rebasing, but now what's happening is Yamv1 is being burned. So the supply of Yamv1 is going down. So like Yamv1 could still continue to trade. Like people may never transition. Like some proportion of Yamv1 will never convert to Yamv2 because there's a window in, you know, in 1 day and 13 hours, you like Yamv1 will be stuck forever. And so like Yamv1 will continue to trade. Actually, maybe I might buy some Yamv1. I actually wish I wouldn't have done all of it. I could, if I would have gone into the actual like Yamv2 contract, like say I didn't trust this website, I could have gone into here and actually like ran the contract, like the migrate, like, you know how we did the migrate here, like we clicked the migrate button and then we did the migrate function. We could have done that in the, like, we could have done that here by coming into this and like approving it, you know, transfer from our old address, transfer how much, like we could have gone in here and typed in, so here we would have had to type in the burner address, here we would have typed in from like my address, you know, here we would have typed in the, you know, the amount we're going to mint. So whatever that was, like we, you know, how much we like, we're going to like, you know, like we could have gone and done this. We used like Yam.finance as like useful interface, but like, if you didn't trust that, you can go in here and do it. So like, you know, like this is like what you're doing, like by migrating your Yam, you're doing this, but not all the Yam is going to migrate. And so as like old Yam, like Yamv1 turns into Yamv2, gets burnt, the total supply goes down. So of Yamv1. And so, you know, Yamv1 will still continue to trade. Like, you know, it's like that's also like part of the staying power of some of these things is that like, even with a critical vulnerability where like they had a massive bug that like still impacts it, like it could have like a constant leak, but just because volatility just happens as people buy and sell these things, like this could very well trade for a long time. And, you know, and for some reason it could just like randomly pump in price one day. And so like, you know, even when people think that like, oh, that thing's going to zero, it's actually pretty hard for these things to actually go to zero. Like it actually takes there to be like no more left where like nobody will even offer you anything else for it. But like, you know, it still kind of operates in this like rebase fashion. So, you know, it does have some staying power. But I think that Yamv2 is probably going to oscillate, you know, probably in this type of range, you know, with the, you know, with this upper bound, you know, who knows how long that'll take, you know, like in Ample, it spends, what is that, 28th of June. So it spent like a whole month above the price target. And then it has spent almost another entire month below the price target. So at least in this first one, this like, it's about like a monthly cycle here. So we don't know because Yam failed on day one. So we don't really know what the cycle was. So Yam, like it's probably going to have its own cycle. You know, unique to like, you know, unique to Yamv2, but you know, it's probably going to have that similar behavior. So I'm still trying to figure out what to do with it. I'm only holding it purely for like experimental. I don't really recommend doing this unless you're like really active, because like I don't consider this like yam farming concept to be as like risk-free yield as I do hex, because yam requires a little bit more activity. Like this is the ample chart, but like act as if this is yam, because this is probably what yam's chart's going to look like. It's like there's windows of time where it's like most profitable to be in it, and then there's like long periods of time where you're like losing, like you're just down, like big opportunity cost. You know, you're having losses that don't regain themselves, like when price goes back up. So like if you bought on this day when price was in these rebase coins, like, you know, this like advanced one. This is why I usually recommend people just like buy some, you know, Bitcoin, Hex, and Ethereum, because like that's like, you know, that's those you don't really have to manage. But like if you bought on this day right here, this whole period of time, your balance of ample is going down and the value is going down. And when price recovers, like say price, you know, makes it past the, let me just make it a little brighter to see. Like if, you know, this cycles back up to this price, you didn't make back everything you lost by holding through this downturn. So
Wow.
like it requires more activity to be successful in these. And so this isn't like a long-term hold. This is like an active trade, like kind of how what like, yeah, and that's where people kind of get confused. Is it like, you know, there's so much hysteria. These people that were buying the price up so much, they thought this was like something that they were going to buy and it was going to keep going up. But like there's times where like people are having big losses by holding it. So like it tries to be a stable coin, but in effect, it's really a volatility coin. And so it's more like a binary option. It's like a high risk, you know, high ROI trade that is not like a buy and hold thing, you know, but it just has these like usually like the things that like, you know, like the whole essence of Dip Catcher is that we're trying to equip ourselves with the skills so that we can execute on opportunities when they present themselves. And in the crypto space, that's usually framed around coins that like you want to buy and hold on to for a long period of time. And so you want to buy like, you know, a super low price. And so, you know, like that whole like framing, it's all about like, you know, you want to buy things low that you can hold on to for a long time. Things like these like rebase coins, you want to buy low because you also want to sell high. Because if you buy low and then don't sell high, you can still end up with pretty big losses, even if the price stays relatively the same. So like this doesn't really fit into like the things that like are more tried and true, that are like good things to be catching dips for. But I kind of can't help myself with these things because like the like price dynamics are really interesting. And the supply dynamics are even more interesting. And so that's really what we pay close attention to. And so these are really exciting, but you know, you do have to, you know, be a little bit more strategic around these things in order to make more money than you would have made just like buying or holding, Bitcoin, Ether, Hex. Like, there's people that make a lot of money, but they're also very knowledgeable and they have a lot of practice. So, you should work up to that level of practice and knowledge before you start experimenting with some of these things. But if you just have like a couple of bucks that you just want to like, try it out with, by all means, like there's only one way to like learn this stuff, and it's like to get practice. But, as always, like, do not, be responsible. Do not risk more than you can lose. You can risk what you spend on Netflix, risk what you spend on haircuts. That's where I've gotten here. Risk what you spend on the movie theater. All the money you're not spending by not like going out, like doing leisure stuff, like during lockdown. That's money that you can either be putting into like your savings through Bitcoin, or to start experimenting with some of these like new financial technologies that are going to be like at the cornerstone of like major institutions of the future. This is like where the stuff gets invented, and so it's always good to be knowledgeable about these things, but it's very, very high risk, as we see play out in Yam, like in real time here, and then with the Ample we talked about last week. So yeah, this is an exciting couple of weeks that we've been catching live once a week. It's been awesome. This is literally like I'm so thankful for everyone that's been tuning in and really holding me accountable for for getting on and doing this stuff every week. But also like it's really made it's helped us like be there for these things. We wouldn't have been able to like understand what was going on in these things and like understand this like whole new type of this whole new type of monetary system unless we were coming getting together every week to talk about these things, because it comes and goes. These things happen so fast. So like really like thank you all to everyone who's been tuning in with me. Like this is like I'm so thankful for everything I've learned just by help like by watching this unfold in real time with you all.
Yeah, Brian. I mean, really extraordinary. I can't believe what's unfolded in the last 6 months from being here with you. It's been amazing. And
yeah, we've seen the halvening. We've seen X go through like its first major bull and bust cycle. We've seen we've seen this like whole like rebase coin trend go on. We've talked about like some of the most important like geopolitical issues going on in real time, with like the money supply, the world questioning what is money, how can we count it? And it's like everything's just happening in real time, and so it's been so awesome, and this is just like this is like it's like it's crazier and crazier every time. Like we're literally talking about a yam farm that as price goes up, your value, your number in your wallet goes up, and as price goes down, the number in your wallet goes down. Like what? Like but these are like the building blocks of like the future financial reality that that we're going to live in. It's like we're already living this financial reality. Like you can hold this stuff. Like you can just log on. Like you don't even need to sign up with anybody. You just need to you need to acquire the Ethereum first. But like we didn't set up an account. Like we didn't have to do all that. Like no one stopped us. So there's a lot of power in this. Where these things are there's a lot of opportunity before they become fully like ingrained in the public. It's up to people like us to take out a lot of that risk, by you buying something when it's very low, like buying like a brand new coin, like buying Bitcoin at this time. Like even though Bitcoin is let's just pull up the chart. Like buying Bitcoin, what you're really doing is you're de-risking it for people in the future. Like by you holding Bitcoin today, you're making Bitcoin less risky for people in the future. And those people in the future are going to pay you for bearing that risk by paying a higher price. They're going to bring the value of your Bitcoin up, because when price was really low, when demand was really low, you as a Bitcoin holder took on that risk. Like you're the one that risked holding Bitcoin when price was in a downtrend. And by taking that risk, somebody later on, when price goes up and some of the risk has been alleviated, they're going to pay you for taking that risk for them. by paying a higher price. So like, you know, that's like really what we're doing in all this, like across all these things, like, you know, being able to like, you know, take that risk, you know, in small degrees, like you don't want to risk too much because it's so risky. Like the reason why the price can go up is because you, at a time when there was very high risk, you were willing to bear that risk. And so people paid you for it later. And so like, you know, that's why, you know, there's a lot of, you know, like just constant opportunity, because like as people start to like, you know, explore new like monetary phenomena, you know, you know, dynamic supply concepts, you know, there's risk and there's reward, you know, because like, you know, the market is like demanding that, like the market demands something that they can, you know, like be able to make a lot of money in a short amount of time. The market demands that. And the market demands, you know, things that hover where the price averages out to be $1. And so like, you know, whenever there's demand, there's opportunity. And when there's like, you know, when there's risk involved with that opportunity, it can compound into these price swings. And the price swings are, you know, where, you know, like you can make up for not being in as early. Like, you know, you can buy dips, and with the amount of money that you make, it's like as if you had just bought in much earlier. And so, you know, just like trying to picture the market as just like a way that people pass around risk and pay each other for it. That's like probably a good way to just to like understand these things. Because like if you just look at the number, like it doesn't really make sense, because what, like Bitcoin's $1,000, Yam is $1, you know, Ample is $1, or no, Ample's 79 cents. You know, Hex is, you know, $0.003. Like, you know, it's hard to like, you know, understand what that really means. But if you instead just kind of look at it on like a long time frame, and then like compare it to where it started, where like when it started, the risk was really high. And then now that the risk is a little bit less high, because like, you know, more people know about it, price goes up. But then, you know, there's still a significant amount of risk involved, you know, like in Hex, like we're only a couple months in. And then, you know, like as, you know, that last bit of risk gets like alleviated, then maybe price will go up, you know, price will go up again. And so, you know, and as this happens, you know, as price goes into these like, you know, something that we, I think, talked about in our first video, these like push and exhaustion cycles, you know, now, you know, like as price goes up by, you know, 600%, what that means is that the risk has been reduced by 86%. So like, you know, that's really like how to approach these. And so like, you know, it's so early where like, even if like you feel like you're late, like it's still very early. And even though like you are late, like in Bitcoin, like this has been around for like 10 years. Like there's already been, you know, like 2.5 full like de-risking cycles where like, you know, these like boom and bust cycles where each time price, you know, goes up and then comes back down, the price that it comes back down to increases. This orange line, like that's up. That means that there's now like within this 4-year period and the next 4-year period, like that difference, there is in Bitcoin, there is 61% less risk over this time. So like, you know, if over this next bull cycle, you know, now like still like Bitcoin is still too risky for people. You know, there are some people where, you know, maybe like they're like, you know, they, you know, either it's too risky or like they don't understand it, or they've been misinformed, or they're just like not really mentally prepared to like unpack this, or they just never took the steps to take action. You know, like the $1,000 Bitcoin wasn't valuable enough for them to like take action to learn how to buy some Bitcoin. So like those people where like overall, like no matter why they didn't buy, even if they didn't know about it, Bitcoin was too risky for them to buy at this price. But as Bitcoin price goes up, it becomes less risky because it becomes more, the industry's larger, there's more liquidity, more money at stake, so the services get better. So like, if we reach a point where, there's like in this next 4-year halving cycle, if this risk, we have like another like boom and bust cycle. And then like from there, like say from here, the risk only, the risk to like the previous all-time high is like that same like 60%. Like say over this next 4-year cycle, we have 60% less risk than what we have today. We could see, price going up, to say like 300K. I think that was like in our first video, we called 300K for a 60K retrace. Like in this next boom and bust cycle, like, a lot of risk is going to be alleviated. And then maybe that's when, the next crop of people are like, okay, it's less volatile now, more, accepted. Major institutions are going to start holding it. Nations are going to start holding it. They already have. Last week we talked about how a major publicly traded company bought $250 million of Bitcoin. And in previous calls, we've talked about how nations have been accumulating Bitcoin by mining because they have energy that is too expensive to sell because there's price interference. And so nations are starting to acquire this stuff. And so as this happens, it becomes less and less risky. That, there's less risk that like someone won't be there demanding it. And so, Bitcoin's had a lot of time to de-risk. That's why like the first, what is that? 200,000%, the first 300,000% move in Bitcoin has already happened. But like, those people that held from that time till now, like this is why you can't feel bad about not buying there. They took 99.98% more risk than you. So like you pay them for that. They took almost 100% more risk, like almost an infinite amount more risk than you. And so like, it like the price reflects that, but like we're only in the 4th cycle of Bitcoin out of about 130 years, 32 cycles. We're in cycle number 4. So, people that are going to be buying Bitcoin for the first time in cycle 8 are going to be paying you a premium for having taken the risk in cycle number 4. So, Bitcoin has, it's definitely a lot more advanced than some of these, like in time as some of these other ones, like Hex. Like when we look at the Hex price, let's look at dollars so it's easier for people to kind of grasp. Like we're looking at here, we're like what, like 9 months in, so like, compared to Bitcoin where we're 10, 11 years in, so we're just the beginning. Things like flow, we are 9 days in. So 9 days, 9 months, 9 years. Like that's the level of risk here. So like, flow is, much riskier than Hex, and Hex is much riskier than Bitcoin. But because of that, the price of flow measured in Hex could go up, and the price of Hex measured in Bitcoin could go up a lot because there's that risk that maybe in the future someone will pay me for it. So, it's with these things, like they come like so fast, like flash in a pan. People kind of, call like crypto people kind of like the gold speculators that like settled in like during the gold rush in San Francisco. It is kind of like that because these things come like a flash in the pan. Like when we look at the flow chart, like flow was only under a quarter for the first, how many hours is that? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17. For the first 18 hours, flow was under a quarter, and it hasn't returned to that level yet. So like, there's such a tiny window for like those like really big, like outsized returns. there is a tiny window, you know, but like just as like the larger, you know, the higher that your starting point is, the, you know, larger window there is. And since there's less risk involved because prices already explored that area, like there's that premium involved. And so like, you know, that's why, you know, it's good to just like get to that first step. Like I know this call, I mean, our calls lately have been very advanced. Like these aren't necessarily, and I know we have a lot of people where this is the first time joining us, but what we're going to be trying to do is trying to publish a lot more like kind of like evergreen, like, you know, content on how to like, just like how to do the basics, like how to set up your MetaMask wallet, how to buy Ethereum, how to, you know, swap on Uniswap, you know, how to buy Bitcoin, how to send it to a wallet you control, like those basic things. Like we'll definitely be sending out some content, you know, to help you get there. But once you're there, like that's what you like, that's like the base level that you need in order to catch opportunities like that, where there's like 18 hours where people, anybody like in the public, like there was no insiders. Like I'm like, I know a lot about this stuff, but by no means am I an insider. Like I don't personally know anybody that does this, that builds these things. So like this is all public knowledge that's like out in the open on Twitter and Telegram. So like that's like why it's so good to just like be equipped to execute on opportunities, because like that's the only way that you can like be at the right place at the right time to, you know, catch something at like the lowest price that it might ever be. And so, you know, we definitely go in depth here, but definitely the first steps are really just to kind of get acclimated with these things and just start practicing, because, you know, you don't like, it's hard to like identify and catch these things if it's like your first time, you know, like the first thing that introduced me to crypto, which is like a whole other story we'll talk about another time. Like, you know, I made some good money, but I left way more money on the table than I made. So I had a pretty big loss. And that's just because I wasn't very skilled. I didn't have the skills. I didn't have the knowledge, and it just takes practice. And so now, you know, and I think like Colleen and Dan, when I was talking to them the other day, they even told me that, you know, they feel so confident to like be doing this stuff just because they've been practicing, and that's really all it takes. And then over time, that just adds up to where, you know, you can start being really comfortable, like, you know, navigating stuff, seeing stuff, you know, on Twitter, on Telegram, and then knowing like what questions to ask yourself and like how to assess it. And then that's how you can, you know, really start to explore some of these like more advanced topics, where a lot of like the, you know, crazy returns can exist. But yeah, I mean, if anyone has any questions about, you know, about anything, you know,
I have a question, Brian. Where do you like? So I don't have the sort of finesse to find like a flow or a yam. What are your sources? Where do you go, and who are you trusting that you're listening to in Twitter? I think you said Twitter and Telegram were your first two places in the morning to go to.
So like pretty much like I can't even really name any off the top of my head. Like I kind of follow like just like a lot of people that are like talking about like stuff in DeFi and in crypto. I never really take anyone for their word. Like, and I try to avoid buying into pumps, because a lot of people that they'll like especially big name accounts, like they buy something and then they wait for it to start pumping, and then they start pumping it, like they start promoting it. And a lot of times it's like too late by the time you like fully hear about it. But I like things where obscure accounts are tweeting about it, like small scale ones. Like I think those are like probably better to follow than like kind of like the mainstream like influencers. Like the influencers are probably trying to pump their own bags, but like you want to find people who talk about them, but like by them talking about it, they themselves aren't like moving the price up very much. Like, so like, you know, people that don't have the incentive to like tell you to buy the top, because they don't really have that much where like the people that they can reach are going to move the price. Whereas like big influencers with like big followings, like by the time they're like publicly promoting something, that's probably near the top. Sometimes it's not, sometimes, you know, like it continues to pump, but like there's usually a better time. Like, but sometimes when like big influencers are tweeting about stuff, I'll start looking for a dip. I'll look for the people that bought on their tweet to get shooken out of their position and be selling. Or like, I'll be waiting for like the influencer to like be dumping into the people that they're like having buy into the top. And then whenever that like down cycle is done, then maybe I'll look for like the momentum and like the trend to continue, you know? So like, I just kind of try to keep my ear to the street and just like look at stuff. I look to see what characteristics people are promoting. If they're just promoting that price is going up, that's not really like, you know, to me, that's just like, okay, the price has already gone up. Like I should have bought that last week. But I look for people talking about other characteristics. So lately, things like yield. I think the first thing I saw about Flow was that it pays 1% yield per day without staking. And so I wanted to see how that worked, because my first impression of Flow was that, okay, 1% inflation is really high. Who does that go to? Because like a couple in one of our other videos, which you should watch, it's the Hex Bitcoin comparison. The key thing that we talked about was where the inflation gets paid to. That's probably the one question that matters in all cryptocurrencies is, you know, it doesn't matter what the inflation is. It matters who gets paid to and in what proportions. So like in Bitcoin, the inflation gets paid to miners, and they get paid that inflation as a fee from all the holders so that they make it so expensive to make it impossible to counterfeit. Like the mining is part of this like anti-counterfeiting software. Like that's what, so the inflation in Bitcoin goes to preventing counterfeiting. You know, and in Hex, the inflation doesn't go to miners. It goes to people who are who have time locked their coins. They've entered a smart contract that guarantees that they won't sell their coins before a certain date. And so in Hex, the inflation gets paid to the time lockers, and more inflation gets paid to people based on how long they lock their coins for. And the purpose of that is because the people who are locking their coins for longer, they're guaranteeing that they're not going to sell their coins. And so they are providing price support. They're helping make sure the price won't go up, because they're guaranteeing that no matter what the price is, those coins can't move. So like in Hex, the inflation gets paid to people who are providing price support. They're helping the price today be higher because they're agreeing to not sell their coins for longer. So in order to incentivize them to do that, they're getting paid interest. You know, like, so people are trading, like people who are buying and selling Hex today are paying people who have agreed to not sell Hex before a certain date in the future. And so that's where the inflation in Hex goes to. And in Flow, the inflation goes to everybody. So it's as if the inflation is going to nobody. So Hex, so like, even though there's high inflation, the inflation quickly gets factored into the price. And so the inflation of Flow is very high. So it's like, so the bullishness of Flow's move to the upside is actually understated, because the price is going up. You know, so price went up, say, if we measure, you know, let's just go from like, just to keep it easy. So 0.2 cents to $2. So price went up about, you know, almost 1,000%. So price went up, so times 10. And then everyone's balance went up by 0.06 compounded per day over 9 days. So 0.01 to the 9. So like in reality, the price of, you know, it went up 10.9x, not just 10x. So like, you know, because the inflation is being paid equally to everybody, from the perspective of all the people inside the Flow community, they all stayed within the same standing. But relative to people outside of Flow who didn't get paid the inflation, they missed out. So somebody who Somebody who, like, let's see, somebody who sold, so somebody who bought, bought flow at $1. So somebody who bought at, sorry, I'm having, so someone who bought it at 1 flow, wrote it up to 2, or even like in that same day. So like even before, like there was like a period of time, because these things happen, I think, every 24 hours. It's like within a day, price had gone from $1 to $2. So somebody who bought at 1 and then sold at 2, and then even if they bought back in at 1, they missed out on the inflation gain because they never held flow when one of those inflations hit. So if you bought like 1,000 flow, sold that 1,000 flow, waited for price to go back down 50%, rebought 1,000 flow, you would have missed out on, part of that gain. You would have had to, in order to like truly have broken even, you would have had to buy back 1,010 flow to make up for that 1% flow that you'd missed out on by just having it held flow during that time. So the increasing supply actually, in the same way that like in Hex, it like, because you earn interest by holding it, you have to by buying high and then rebuying back in at a lower price. It makes it like that, so that you have to buy in at an even lower price to factor in for the inflation that you missed out on. Like the inflation that you would have earned by just holding the Hex. That's opportunity cost. And so that has to get factored in. So anyone who's selling flow is factoring in that like that flow that they're holding today could become 1% larger tomorrow. And so that's like what everyone's factoring in. So that, I think that's part of what's contributing to this, is that like, if people like, rather than people trying to like sell high then rebuy back low, most people that try to do that anyways lose money. Like people that trade end up buying the top and selling the bottom. So like they end up losing money anyways. Like probably only like less than 10% of people will actually make more than 1% trading just anyways. So that like 1% like ROI price floor, that actually keeps out a lot of the trading. And a lot of the trading is what like a lot of the people are like, who would otherwise be like, selling the price down. Like there aren't that many people that are like, or they're just less people that are selling high to try to buy low, because the accuracy in which they sell high and buy low, they have to be more than 1% more accurate in how well timed they are for it to be worth it. Like on like the risk adjusted reward basis. So like these inflation dynamics actually help the price go up, even though like because the inflation's happening equally to everybody. Like it's as if like no inflation is happening, but like part with like the psychological effect of seeing the balance go up. And then also because like the inflation represents opportunity cost, it actually like can support the price. So that's why I think like, I think flow kind of has like some elements of Bitcoin, where it has like those like long-term halving cycles, and it has elements of Hex where like inflation gets paid to holders, as opposed to in Bitcoin where the inflation gets paid to miners who are actually sellers. Like in Bitcoin, the inflation gets paid to people who are selling Bitcoin because they're mining. They have to sell to pay power costs. Flow and Hex are being paid to holders. So it could have favorable price dynamics in that sense. But the thing that like Bitcoin has like a resounding advantage on over this is that like, the risk of going to zero is so much lower, so like, there's still like much higher like potential outcome, but because of that, there's much higher risk of it truly going to zero and like really wiping you out. So like, because of like the time difference, like Yam has been around for 9 days. Bitcoin has been around for, let's say it's 10 times 365, but it's more than that. So 9 divided by 3650 is something like, so flow has been around 0.2% of the time is Bitcoin. And every day that goes on like, it makes up a little bit of ground, but until like until that difference of days, until that, until 3650 is now 99% of the total difference. So divided by 0.01. So in 365,000 days, will there be like a negligible difference between how long they've been around? So in 100 years, will like the time difference be negligible? Like Bitcoin, that's why Bitcoin just is kind of like the king in all this, where like, it's like where, it's like the most sophisticated because it's like the least risky. Like Bitcoin is the risk-free asset in all of this. All these ones have significant risk compared to Bitcoin. So like these things have just like a lot of time that like no amount of new money coming in or no amount of like software innovation can make up for that lost time. So that's just, part of this like risk premium that gets allocated to people. And then, projects try to make up for that with the inflation, in incentives, but, like these are still, experimental and there's a high degree of risk, but, because of that, that's where the reward comes from. And that's why we celebrate volatility. And because that's what provides the opportunity that, that you can have to, just amplify your income. That's really the name of the game. Like you want to, in the words of JC, you want to make more money with less hours of work. And so like, that's kind of what all these things serve in the market. Does anyone else have any questions before we wrap up?
Well, I just want to mention really quick, sort of as Brian was mentioning, I had told him yesterday, actually, just within the last week, everything started to like sink in. And honestly, a lot of that has to do with practicing getting on MetaMask, even if I'm not like buying or selling or like swapping, just logging in and then getting familiar, like doing like the little things, practicing has helped me a long way. It's so, yeah, now I feel a lot more comfortable, and like I'll get up and I'll look at the chart, and then yeah, I don't know, I'm still new at all this, but I've just been consistently showing up, and like even if I don't understand it, trying to like not worry about that and understand like the little things ultimately like equal the big things in the end. So I appreciate all the work you've done with us, man. It's huge. Like, thank you so much.
Yeah, well, yeah, and thank you, Daniel. Thanks for helping. With Daniel's been the one posting these to YouTube and posting on the DipCatcher Telegram. So like, thank you so much, for that. That's really helped me, stay up to date with like a lot of these things and like keep sharing. And I'm always happy to be sharing with you all, because that's how I learn. Like I like the time that I spend just like trying to like find interesting things and unpack some of this stuff for you all. I feel like that really puts me ahead too. So thank you all for joining us. And yeah, I look forward to who knows what's gonna we haven't decided what we're gonna talk about next week, but if you have anything that like you'd like to maybe be covered, feel free to like just post it in DipCatcher. I'll probably try to make a short answer there, but then we can always go into more depth on these calls. But yeah, thank you so much for everyone who stuck around. This is an exciting last couple of weeks, and I can't wait to see what continues to unfold over here. So thank you all so much for joining us, and until next time, keep catching dips, keep your ears to the ground, and let's all go have some fun. So we'll talk to you all later. Thank you so much.
Thank you guys.